I got a new trade that I'm going to show you, and I'm going to show exactly why it's important to know what's going on in the options market and how to be strategic with options to make better investment opportunities. So let's take a look here at the beautiful chart of Fairfetch Ltd. Now, right now, prices are trading at $19.60. Take a look at the left of the chart. It was $6 back in March and has just continued to rip higher along with the marketplace all the way higher. Now, if we look all the way to the left here, we have $22, and also we have a big gap here in pricing. So when I look at this, it's a very volatile stock. Now, what we're trying to accomplish when we look at all of the stocks that are available for us to trade or find opportunities to make money, where is the right of the chart going to go? Where is the puck going to go? Now, is prices going to go higher from here, or are they going to go lower? Well, we're not quite sure. There's a 51% chance that prices continue to go higher because that's how markets work. But could we see pricing pull back? Sure. However, if we just used stock, we would have to pick one or the other or move on to the opportunity. Now, if we use options, we can benefit with options by being more strategic and what I refer to as letting the market beat us. So let's take a look here at the options montage. Now, this was a spread trade that happened. Now, if you are not familiar with options, or if you're trying to find unusual option activity, you probably will be fooled by this. What happened here is that these contracts back in October, or this October 8th expiration, they were sold several weeks ago. So they were sold to open, which is a bullish bet. They sold puts, meaning that they wanted prices to go higher. Again, when you sell a put, you collect premium, and what you're saying is, I'm going to play defense, I'm going to let the market beat me. What happened here is that they took profits and they rolled higher, and what they're looking for is prices of this stock to trade above $12 for the next 101 days. This is October expiration. So what they did was if you looked at this on the time in sales, this would look like a spread. This was a vertical spread that was sold, but they were selling, or they were buying back these 8 puts, and then they rolled that contract into the 12 by selling. So they bought the 8s and sold the 12s to create that spread. That's a rolling spread, but they're rolling their profits, locking in their profits at the same time, and looking to make more profit. So again, when we look at that strike with prices at $19.50-ish, and we look at that strike, we can use the delta, or you can use the probability of in the money. At this point, there is a 21% chance, 22% chance that prices will expire in the money. That means you have an 80% chance that prices will expire out of the money, around 78% to be exact. So when we look at that chart here, again, back to this chart, where's $12? Well, $12 is all the way back here. It's all the way back to the 2020 levels here back in January. If we did get a pullback here, sure, those pricing of puts will increase, but this is the bet that they're making. This is the amount of money that takes to be able to control this. Going back to this montage here, the amount of money that takes to sell 16,000 puts. And even though they sold these puts for, looking at the price here, they sold those at 45 cents. So they took those and they got $45 per contract. That's a substantial sized bet that they are looking to either have prices stay above 12, or in this instance, they could be looking to take delivery of shares at $12 or better. So when we look at that positioning, again, long term, the next 101 days, and it's not really long term, it's more next several months, what we're looking at here is, instead of letting the market, I'm trying to dictate where pricing of Fairtech could go, because what we could see here on the chart is that prices could just trade sideways here. It could go, it could go to 16 and go back to 20 and go 16, and you have to pick it. When you sell a put, you let the market beat you. So this is a way of playing defense and collecting that premium and saying to the market, beat me. And this is how most people, most professionals approach the market. They say, I'm going to put my bet here, and I am going to say, market, beat me. But in the instance like here, what I suspect will happen is that they will, since they bought these back, they bought those puts back at around 12 cents, they're not going to let these expire. What they're going to do is probably look to take about another 30 cents out of these 12s. And once they get that 30 cents, they probably either will close the trade out completely or they will roll it again. And this is why it's important to follow that roll, because this is where you want to be. I want to be this. I want to be behind these people because they're making these substantial size bets. They're indicating that their belief, they're putting big money on the line saying, look, we think prices are going to go at this level. Where you don't want to get crazy is making the bet and saying that this is the all be all, because they could be looking to take delivery of these shares or willing to take delivery at $12 and saying that's the value. That's the value that they're looking to get in, where they want to get in and take shares of that. So you got to make sure you have that account size. But again, when we look here to make strategic investments, strategic trading opportunities, this is one way. And what we're looking here at Fairtech, not necessarily going to go higher, not necessarily going to go lower, but maybe just sideways. But sideways, and when you sell premium, still works out, you still make money.